Hello, in this lecture we will define overhead. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of overhead is factory activities supporting the production process that are not direct materials or direct labor, also called factory overhead and manufacturing overhead. Notice this definition is defining by excluding or saying what the factory overhead is not, meaning factory overhead in terms of inventory is not going to be the direct materials or the direct labor. That means that anything else within a production process of inventory within a manufacturing company, manufacturing inventory that is not direct materials or direct labor will go into overhead. And we can think of overhead as that bucket of everything else that we want to apply to the inventory. For example, if we're making tablets, we want everything that's within the cost of that tablet to be included in the tablet. The two things that we can apply directly to the tablet will be the materials. We know exactly the types of materials in terms of plastic or metal that will be in the tablet, and the labor that's worked directly on the tablet. Now, those are going to be separate from the third category we will have of factory overhead, because these two items here we can apply directly to a job or directly to a process. Those will be the two types of methods we will use if we're manufacturing something, manufacturing inventory, manufacturing something like these tablets. These two items we can apply directly to those units, those jobs, or those processes. That's not what we're looking at here, because we're looking at the stuff that we cannot apply directly to the inventory units. We want them applied to the inventory units in some way, but we don't know exactly how to do that. So what we're going to do is we're going to put it into this other bucket of factory overhead or just overhead, and then we will then apply it out at a later time to the individual jobs or processes using some type of estimate. We can think about it as overhead in anything where we do the job. So if we're making these tablets within a factory, then anything related to the factory, the depreciation on it, the rent on it, these are all things that we can't apply directly to this one particular phone or particular job or particular process, but we want to, some way, include that cost in that inventory. So we're going to put it into overhead and then apply it out using some kind of estimate. Things like a supervisor salary, that's going to be something that we can't apply directly to one particular phone, job, or process, but it is something that we want to apply in some way, the salary to those particular phones. And we're going to do that by putting it first into overhead and then applying it out using some type of estimate. Glue, similar. The glue is going to be directly in the tablet. You might think it would be a direct material, and it could be. However, because of the cost of the glue, it's probably not worth us tracking it. Therefore, we're going to put it into overhead and then just apply it out, most likely based on a cost basis analysis. Then if there's any maintenance on the factory, all that upkeep, that's where we make the inventory. Therefore, anything to keep up the factory in order, we need to put that cost into the inventory some way. We can't put it directly there because this work is being applied to all the inventory. So we have to first put it into overhead, then apply it out. Anything like utilities or rent or depreciation on the factory, depreciation on equipment, those are all things that we want to include in the inventory. We want to divide them out to particular inventory units, jobs, or processes, and therefore we're going to have to put it into the overhead first and then apply it out using some type of estimate.